So the broker or the seller says $470,000 EBITDA, but what do you say as the buyer? And here's how I would look at this business, the one that we currently have listed, and this is the maintainable earnings that if I'm a buyer, I would see. Okay, let's dive into this business and look at this from the buy side. As I mentioned, we have advertised here an underlying EBITDA of 487,000. But here's how I would look at this if I'm the buyer and if I'm being conservative, which all buyers will be. And the broker's role here is to find ultimately the maintainable business earnings and be able to represent that to the buyer. That's what we've done in the advertisement, but it also has to stand up under the test of due diligence. So looking at this from a buyer side, if you're the broker doing the valuation or undertaking the transaction, you have to look at it from the buyer's perspective. Otherwise, you will not stand the test of due diligence and you'll waste your client's time and probably put your client in a position of sensitive information being out there in the ether, which nobody wants. And I always tell clients, this is really important to get some of your skeletons out in the closet. Every business has certain skeletons. Some skeletons are subjective, some are objective, but every business has risk that a buyer will interpret differently to the seller. So I just want to show you, if I'm the buyer that's looking at this through a prudent lens and being conservative around how I have to adjust for risk, this is the approach that I would take. And this is why we advertise this business at 306,000 or 7,000 maintainable earnings. Okay, firstly to point out about this business, by the way, really consistent top line revenue trend in the last 3 years with an increase in 2026. And we'll get to what caused that in a moment. Gross profit, also very healthy. We have a relatively consistent gross profit trend over the last 3 years. In fact, very consistent. And so that's a very healthy sign, but we're not going to dive into those fundamentals at this point. The first thing that I want to make sure that you're adjusting for as a buyer is to make sure that the cost of replacing the owner is covered. The cost of replacing the owner that is leaving needs to be treated as a business expense. This is not seller's discretionary earnings. This is not what people refer to as EBITDA, which stands for proprietor's earnings. And I think too many brokers and probably buyers accept seller's discretionary earnings, or EBITDA, which are essentially the same thing, as being the profit that they will take away from the business. It's not. If you're looking at this from a seller's discretionary earnings standpoint, it means that you are considering the salary that you are being paid for working full time in the business as the business's profit. It's not, it's your salary. So it's a really important distinction to make. Now, what we've done here is we have, I'm not going to go through all of the add backs here or all of the normalizations, whatever you want to call them. That's not the purpose of this exercise. The purpose of this exercise is to work through how we arrive at the 306,000 maintainable business earnings when last year they had a profit of 486,000. Okay, so, but one of the key calculations here is adjusting for the owner's salary. So you can see here we have taken the total owner's salaries for the last 3 years as per their PAYG. Now, one of these owners is completely silent, so they have not been working in the business. So we add back these salaries, but then we also need to leave an adjustment in place to make sure that the cost of replacing that owner exists as an expense to the business. Okay, now the first obvious thing and the most cookie cutter thing to do for probably if you're an accountant or if you're looking at a very generalized way would just simply to be to look at the last 3 years and look at the average the average EBITDA and infer that that's transferable. But when we've got this sort of level of fluctuation, to me, perhaps that's not the best way to do things. And again, it's just a very simple, high-level cookie-cutter way to get a sense. But if we look at the average of the last 3 years, we're looking at about $330,000 EBITDA. And where we have really looked at discounting for risk here is around the quality of earnings. When we look at the revenue, because what we saw in 2026 was actually slightly abnormal in terms of its revenue. Very consistent in 24, very consistent in 25, and then a jump up of about $400,000 to $500,000 in 2026. Now, when we then went and looked at the customer profile to start doing a quality of earnings assessment, we saw an anomaly straight away. And that was because there was a significant new customer who became their number one customer in 2026. And we then interviewed the client about the ongoing relationship of that customer. What we learnt was that that customer was most likely a one-off customer. There are no further projects booked in the foreseeable future. So one of the things that we have to do is actually remove that customer from the profit and loss statement. So here's how we did that. And again, this is very high level. This probably could be perfected if you were to dive into this deeper, but this is just for the purpose of this exercise. So the project revenue generated by that customer was around $490,000, and the project gross profit that contributed to the total gross profit was $170,000. That actually represents a gross profit of 15% of the total gross profit generated by the business. So simply, what we've done is we have now created a pro forma P&L where we remove these characteristics and allocate also operating expenses associated to delivering the project for this customer. So we have revenue, the new revenue line becomes 2.94 million. And when you compare this to last year, we actually can see that there's a slight decline, okay? But it's still sitting pretty comfortably around that $3 million mark, which is great. So we have 2.549 million in revenue. Gross profit goes down to 975,000. And operating expenses also goes down to around 748,000, because if we're utilizing 15% of the gross profit as the metric, then the same thing must be true for the OPEX. And now this is the part that is not perfect. It may not be true. The business may have really sucked additional resources because it was a large project from the operating expenses. But also keep in mind, a lot of those operating expenses, or some of those are fixed as well. So we have our new GP of 975,000, our new OPEX of 748,000, our new net profit of 227,000, and then we also apply the same principle to the adjustments. So the adjustments are not 100% of the adjustments. We're using 15% metric to apply the adjustments. So the total adjustments have come down, and therefore that gives us an adjusted EBITDA X of this customer of just under $400,000. Now that still looks quite high. So there's a further story there. And when we looked into this a little bit further, the previous year's net profit was down because the owner had spent a significant time away from the business and invested more and actually wasn't around in the business despite taking these salaries, and invested more in administrative staff members. Now that trend has completely swung the other way. That owner is now back in the business working full time. And in fact, due to advancements in some of their technology and their tech stack, they've actually been able to reduce their administrative costs. So the big improvement in this year, and the reason why this year isn't sitting around $300,000, if you factor in, or if you keep the client, the number one customer intact, is because the administrative staff costs have come down by approximately $100,000. So basically by a full-time wage, which is fantastic. So because of this sort of minor transformation in the last, let's say 12 to 18 months, what year best reflects the current trading environment and the current operating expenses of the business? Well, of course, it's the most recent year. So what we've done is we've allocated a weight of importance to 2026 of 50%, being the year of closest proximity to the current trading year, and 25% to two previous years, just to capture the volatility and the historical performance of the business. Now, we haven't weighted this 50% against the $486,000 EBITDA. If you have a look at this, we've actually weighted the 50% against the revised EBITDA after removing the key customer that isn't maintaining in the business. So contribution of 199,000 for FY26, then 50,000 for 25, and then 75,000 for 24. So here we arrive at a maintainable business earnings of 325,000. Now, what we've advertised again is 306,000 maintainable business earnings. And we always like to understate, to either just leave a little bit of room for interpretation, a little bit of room for due diligence, to make sure that we are not overstating anything and getting our client in trouble further down the track so that we end up back at the negotiating table. If you do a rough estimate on what sort of capitalized multiple rate that represents, well, we're looking at a return on investment of 40%, okay? And we're looking at a capitalized multiple rate of 2.53, which is bang on the industry. Okay, I hope that was helpful. Happy buying and selling. And if you are interested in this business, make it fast. We are flying through inquiries. Call or text me or email me 0450 326 146. And my email is dan@vbaaustralia.com.au. Happy buying and selling.